welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, up to make it actionable, understandable, and clear. What a week. What a show. We had one of our favorite moments on this podcast, annual moments. The Berkshire Hathaway letter has dropped. We're going to look at what Mr. Warren Buffett is teaching us. He's one of the foremost educators. He's known as an investor, but he's one of the foremost educators in the personal finance space. We're then going to look at a Wall Street Journal article that hits on a theme we've been talking about for years. I think the Journal is starting to catch up. They can't compete with our resources. For years, it's this dilemma of valuation, United States equities versus international equities. We're going to talk about what expensive means and what it doesn't mean. And then something you didn't expect, but in Robert's Corner, I found an industry with a great number of corollaries to the personal finance and investing space. You guessed it, the dishwasher industry. So for all my dishwasher fans, I'm going to keep it at the end of the segment. You're going to have to hang in there by your nails. Just hang in there, and we'll get to that. You've been waiting years for me to talk about the correlation, but it is fascinating. You'll learn a lot about dishwashers too. But at the top, Mr. Buffett, many of you already know, but for those that don't, Mr. Warren Buffett, one of the greatest investors to ever do it. He's, I believe, 94 years old now, worth over $100 billion. That's one of the greatest track records of investing ever. And one of my favorite parts of this year's letter is he highlights the importance of admitting mistakes. And what he says, this is the first page of the letter. He says, during the 2019-23 period, I have used the words mistake or error 16 times in my letters to you. Many other huge companies have never used either word over that span. Amazon, I should acknowledge, made some brutally candid observations in its 2021 letter. Elsewhere, it has generally been happy to talk in pictures. It has been happy talking pictures. Now, Mr. Buffett owns the company, so he has a great deal of confidence. He's not going to fire himself as CEO. He has one of the greatest track records ever. So he, perhaps we could argue, has the ability to have that sort of candor, whereas Joe gets hired by some multinational corporation, owns almost no shares. It's going to be tough for him to say the word mistake. And Buffett even explains there's litigation risk if you, as an executive, confess to your shareholders that you made some mistake that lost them money. Here come the lawsuits. But what I thought was a great corollary is if you are considering hiring a financial advisor, this gave me an idea for a new question you could ask that advisor. What are some mistakes you've made in your personal investment life? And what are some mistakes you've made providing advice to clients? I think that would be interesting. That's not one I've thought of previously. The questions I usually suggest when you're interviewing a prospective financial advisor are, what does it cost? Can you explain what my all-in cost will be? Usually a lot of fumbling of papers that goes around and an appeal to talk to corporate about that. That's a really important question, how quickly the advisor answers that. I found questions that are worth very little is, are you a fiduciary? The word's lost all its meaning. In fact, everyone says they are, so I don't know what it means anymore. But the nature of conversation, then, what is your philosophy of investment? What are some books on investing that you like? These are the questions you're asking this prospective advisor. And then what are some mistakes you've made personally and then giving advice to others? I think that would give you a lot of good data that, lo and behold, you really don't get when you're given the dog and pony show at whatever, Big Bank ABC, Wealth Manager ABC, whatever. It can be confusing. I also found this interesting. Buffett talks on page 4 of this letter. See, I save you from having to read it if you don't want to. Listen to this. Their performance was good. Berkshire Hathaway, this holding company. So Berkshire is a company that owns a whole lot of various businesses, but they roll it up into this one mothership of Berkshire Hathaway. listen to this. In 2024, Berkshire did better than expected. Although 53% of our 189 operating businesses reported a decline in earnings. Wow. I'll say that again. 53% of the 189 operating businesses that Berkshire owns had a decline in earnings. Now, what's the actionable advice for us? Diversification does matter. Although Warren Buffett is not himself investing in index funds for Berkshire, boy, it's starting to feel like it, the number of holdings he gels together. And it doesn't take very many winners to overcome all the losers. That's some of the secret sauce of indexing, the low cost being another secret sauce. But the idea that you could have 90% of your holdings just flat or slightly down and a couple great winners, and you could be up. And you could be up significantly. In fact, that's what has been occurring these past couple of years. And index funds have been derided and decried as, on shaky sand, there's a terrible foundation here. You're riding the backs of those 7 stocks, tech stocks. Without those, you're nothing. They're not wrong. Those detractors are not wrong, but it's a badge of honor. And here's Exhibit A, Buffett, although, of course, a little different environment, 189 operating businesses, 53% of those decline in earnings. It's not flat, that's a decline. So take heart, index fund investor. Your diversification is a feature, not a bug. It's a good thing. And then I get this question a lot. Oftentimes when investors, I think about this myself, hey, is this a good time to invest? We ask that, right? Is this a good time to invest? And what's a decent thing to look at is, well, are really smart people investing? Well, who's the smartest? Probably Buffett. Who's the most well-regarded? Probably Buffett. Well, he's sitting on a ton of cash. He makes a little bit of defense of this. He does so on page 7 here of his annual report. He actually reduced his stock ownership. So I'm going to read this. While our ownership in marketable securities moved downward last year from $354 billion to $272 billion. When he's saying marketable securities, he's saying publicly traded stocks. It went down. Now, a lot of people look at that and say, well, Buffett is seeing things on his dashboard. He's reading the tea leaves, and he must think businesses are overpriced, and therefore he's selling. If he reduced, in an upward moving stock market, he reduced his stock holdings to the tune of $80 billion. What does he know we don't? You can appreciate that line of thinking that an investor might digest. Well, as Lee Corso would say, not so fast, my friend. We should be very careful about trying to extrapolate actionable investment ideas from anyone, even Warren Buffett's cash holdings. I wouldn't think a whit about trying to make a market timing decision based on Buffett's cash holdings. Now, of course, you can look back in the past, and there were instances where he was correct, the late 90s being one of them. My fear for the individual investor is if they start to anchor to intelligent people and their cash holdings, it'll just increase the paralysis by analysis, and you'll never invest. I go by a simpler framework, which the best time to invest was yesterday, and the next best time is today. Agnostic to market valuations. Now, why is that? Why can it? For every buyer, there's a seller. Who's to say that the market is fair valued or overvalued or undervalued? Reasonable parties are constantly, all throughout the day, 5 days a week, trading their fractional ownership shares in these businesses for cash and doing so in a fair and open environment. It's my conviction that's the best way to tell what the value is, and therefore the market's always fairly valued. Now, of course, intelligent folks will disagree with me, but for me and for my clients, that's what I preach, because on the long chart, on the 1801 to present chart, the really long one, it really doesn't matter when you get in. This is, I think, one of the great confusions in investing is we over analyze on the timing of our entrance into the market. We anchor to that. We think it's just so important, when in reality, on the big chart, when you zoom out, you can hardly see the downturns. I'd encourage you to look at a 200-year chart and you can kind of squint and see 2008, and you can see 1929, but it's hard to see a whole lot else. But in the moment, boy, do we feel that volatility and think, oh, I can't be too early, can't be late, got to be right on. Take that pressure off yourself. Just click the button and go away. You may be right, you may be wrong, but what's worse is hanging out in cash. And that opportunity cost of hanging in cash, that's certainly going to be a cost where as you don't know if you'll get your timing right or not. Then in closing the letter, Buffett talks about buying these Japanese holding companies. So this is unique to Warren Buffett. He typically only invests in United States companies. That's his preference. But he tells the story that 6 years ago, Berkshire began purchasing shares in 5 Japanese companies that were similar holding companies to Berkshire. He listed the names. And what I found so interesting is these businesses, he has in this letter, he says, about a multi-decade, 30-plus year view on owning these things. And he says we will probably own more of these in the future. Now, you and I aren't market timers or stock pickers, but we can at least borrow from Buffett his mindset. He's making this decision, and he makes this one decision, and he is not going to change it for the next 30-plus years. That's the right way to think about investing. Once we purchase something, we really shouldn't have this manic, obsessive idea that, how are the holdings doing? Is it up? Is it down? Is it sideways? We should think about investing like farming. We're focused on the income-producing capabilities over time of assets owned. We really shouldn't anchor to the notional up and down value that Mr. Market yells at us each day. So I thought his explanation of his hold profile on these 5 Japanese holding companies was a great encouragement to us, because Buffett seemed at 94 still has a long-term view. So surely we can have a long-term view. And then in the Wall Street Journal, this is Mr. Spencer Jacob. He's saying the gap between expected returns for large growth stocks that dominate stock markets today and cheaper alternatives has never been so big. Here's what is attractive. Well, what's he doing? This is what we've been doing and many others as well. He's saying, the U.S. stock market and growth stocks, these are companies that predominantly are increasing their sales quickly. These are typically technology companies, whereas value companies might be energy and banking and so on. He's saying the expected return on these U.S. growth stocks is very low, whereas expected return on value stocks internationally is much higher. Well, Mr. Jacob goes in to the data, and he says the expected return for non-U.S. developed market stocks, that's Japan, Europe, is value stocks is 10%. Topping that, emerging market value, again, these are these stodgy old line companies, is a 10.5% return over the decade, whereas the predicted return for U.S. large growth stocks is 1.8% annually over the next decade. That'd be negative after inflation. Yikes. So, but haven't we heard this story before? I'm prone to believe the data. That's my posture. However, I don't believe it enough to make any actionable changes. For example, if you were really committed to this and you had maybe a tax-deferred account, an IRA or a 401k, you'd read this data, read the tea leaves, and then just, let's rotate into international value. That's what the machines are telling me. But I've gone back and looked at the machines, and the machines are wrong sometimes. Their estimation, when they are projecting future returns, they are anchoring to historic returns. And they're saying this sort of reversion to the mean, this idea that things will go back to their historic values, that will occur, and therefore we have some sort of predictive powers in saying, yes, U.S. stocks will struggle, foreign stocks will do well. My solution, as Lord of the Rings told us, one ring to rule them all. What about one fund to rule them all? Ticker VT. It's an exchange-traded fund. VT, Victor Tango. It is Vanguard's Total World. Total World. You don't have to think about anything. It's got value and growth. It's all in there. It costs 6 basis points, 0.06%, super cheap. And you click the button one time, and you get out of this arena of value versus growth and international versus domestic and All those things that are going to trip you up. And ultimately, it's the psychology. I think if you start to stratify your investments and say, all right, I'm going to do, this was all the rage when I was in college, I'll do 5% growth and 5% value and 10% international value and 10% international growth. And then I'll come over here, I'll do 3% mid-cap value US and 2% mid-cap value growth because my model, I think it is a long shot you will stick with that. And I think it's unlikely that will enhance your performance. If that was the case, if we could simply rotate into certain asset categories that the machines told us to, why are all these endowments and pension funds underperforming every year? Simple wins. And what a transition to my dishwasher segment. Bring the kids in. You've all been waiting. You were waiting for this. I was on a deep dive. 2 videos. My dishwasher wasn't performing. I do a deep dive, and this guy, I don't know if he loves index funds, but he would love them. He basically said the whole dishwashing industry is a sham in a sense. When you buy a dishwasher and it says it wants, whatever, Cascade or it's all a marketing agreement. It's all gobbledygook. Moreover, the pods, those little pods they're using, all gobbledygook. Nothing. That's nothing. In fact, they're not helpful. What you should do, and I'll see if I can find the link, put it in the show notes. Go get you like a Great Value or Walmart or store brand powder. Make sure you pour it in. Pour it in, kind of just open out on the dishwashing door. Then just put a little bit in that little container. And wouldn't you know it, the inexpensive, no marketed, not pushed on you solution, lowest cost actually produces the best, cleanest dishes result. And boy, wasn't that an analogy to investing. Not every industry works like that, by the way. But dishwasher detergent specifically, dishwasher detergent works that way. The more expensive the product, the worse the performance. Stick with what you can control, which is keeping those costs low, that investing simple, and that time horizon long, because that's what's going to give you the best shot on your investing journey. Until next week.